What's up, guys? I hope you're doing well. James here from jamesdforsythe.com. Continuing on with the monetary and pay or money and payments paper from the Board of Governors for the Federal Reserve. I know this entire past week has been talking about central bank digital currencies and going over this white paper and everything else, and so near 40 pages. Um, but one of the things I really wanted to get into, and I elaborated this last night on last night's video, of how important it is to understand like the different types of money, um, money, however you want to say it, what we use as currency slash money. Um, so with that said, we will go straight into the screen share. And this is the last video done with this paper. There is one more appendix after this. However, I will leave that to you guys, for you guys to read. Basically, it's just about like the payment systems and stuff. And when we get to it, I'll elaborate more. So, with that being said, come over here. So, it's like in I think it was the first video when we first kind of got preliminary with this, the different types of money, right? So there's three different types, right? There's central bank money, commercial bank money, and then non-bank money, right? And so at least how they're portraying it, we're not going to get into the philosophical argument of like, what is money and everything else. Not in this video, at least. That is like that's a very, very important concept, and a lot of discussion needs to be done. I think there's even I haven't gone too far, and I haven't listened to a lot of his podcasts, but I think it's literally called the What Is Money podcast, or the What Is Money show, or something. I think it's by Robert Breedlove, but I haven't consumed a lot of his content yet. I know of him from like other interviews he's done with other people that I do listen to, but haven't specifically listened to his yet. But I think, anyway, that's a side note. So central bank money, right? So one of the things that you should know, or with all of these, that what we use as money is debt, right? It's the US dollar is debt. Well, the assets denominated in US dollars are forms of debt in a way. So basically, and you kind of notice that across all of these things. And that's one thing that really kind of helped synthesize in my head by doing these past few videos is, like what we consider the different types of money, even now with, from different perspectives, they're all forms of debt. When you're using treasury bills from a financial institution, how they're using it as collateral for like say reverse repos or whatever, the treasuries are debt of the United States government. And then you have mortgage-backed securities. They're mortgages packaged together, mortgage debt. And then you have the corporate debt that's also used for it, sometimes for commercial paper. Corporate debt. And then you have the physical dollars in your wallet. The physical cash is a liability of the Federal Reserve. It's a debt of the Federal Reserve. The money in your bank account, right, is a debt, right? It's the debt of your bank. That is your money in your bank account is a liability of your commercial bank. That bank, your bank, owes you that money, right? And that's what really like where this gets into. And so for central bank money, to try to keep this structured as possible. So in the United States, central bank money is a liability of the Federal Reserve and comes in two forms. The physical currency, I talked about before, which circulates among the general public and sometimes held in banks. And then the digital account balance is held by banks and a limited number of other eligible institutions at the Federal Reserve, depository institutions. These are bank reserves. The second form, this digital account balances, these are the bank reserves you hear people talking about. The physical currency has legal tender status, right? And so the physical paper is legal tender. You have to take it, right? In forms, or it can be used to pay debts, private and public, right? And so it's literally you're paying when you go to the store and you pay physical cash. the store a liability of the Federal Reserve. So now you're transferring that note. It's called a Federal Reserve note for a reason. You're giving that liability, your asset, the Fed's liability, to the store. So now it's still the Fed's liability, but now it's an asset of the store. And so things are a little bit different behind the scenes when you get down into commercial bank money, right? Which are your dollar denominated balances held by consumers in commercial bank accounts, commercial bank money, your bank accounts, business bank accounts, whatever. It's a liability of the bank. That's why there's a difference between bank reserves and M2, right? So the money floating around in the real economy, right? That's why the whole argument, like with the whole idea of quantitative easing being inflationary, or no, I'm sorry, quantitative easing being money printing. It's kind of. Not necessarily. It depends on where that debt is coming from. So the quantitative easing is when the Fed is buying debt, right? Whether it be in mortgage-backed securities, whether it be in treasuries, whether it be in corporate debt, whatever it happens to be. So they're buying that form of debt, that form of money. Debt is money. I know that's like I don't know if that's a trademark or whatever, but I hear it somewhere. I know Robert Kiyosaki says it a lot. The whole debt is money, but I don't remember if there's like someone who's actually that saying is like attributed for. But I guess it really doesn't matter. It's 3 words, but it's true. That is what this is. And so, of course, my side note made me lose my train of thought. But anyways, a statistic for central bank money, just to try to get me back on track. As of November 2021, there were around 6.39 trillion dollars of central bank money, and of this, 4.18 trillion was in the form of balances at the Federal Reserve, bank reserves, and then 2.21 trillion was a form of circulating cash, right? And so that's base money, M naught, right? The central bank money. And then we go down to the commercial bank money, right? And as of November 2021, same month, commercial banks held approximately 4.76 trillion in demand deposits and 13.47 trillion in other liquid deposits, right? And so the reason this is important is because banks extend loans to consumers and businesses funded in part by their deposits. Now they can give out loans based on other stuff, other reservable assets, so to speak. I actually think that's the technical term that they use, is reservable assets, or maybe it's reserve. I don't remember. Something along those lines. It's been a minute since I read that section, and I believe that's the language used in the Federal Reserve Act, but it's been a minute since I read through that passage. But anyways, trying not to lose my thought again. It's the end of the week. It's bound to happen. Okay, so as of December 2021, there was around 16.41 trillion in bank credit outstanding, reflecting loans and other credit provided to households, businesses, and governments. Today, the safety of commercial bank money is supported by Federal Deposit Insurance, the FDIC, which is subject to certain limits, to $250,000 limit for FDIC. And then a system of prudential regulation and supervision, and access to liquidity from the Federal Reserve. So kind of the whole nuance between this, right? I kind of went a little into quantitative easing, kind of to show the difference in the types of money, right? And so the Federal Reserve does not print the money that shows up in your bank account, right? That's because that's not a liability of the Federal Reserve. That's a liability of the commercial bank. That's what we're talking about. But as we said before, central bank money, these digital account balances, the bank reserves, the Federal Reserve can create those. So those go on the balance sheets as assets for the commercial banks, and then from there, they can lend out and create commercial bank money, right? So that's the whole reason. One of the reasons why QE can technically not be inflationary, or not QE, sorry, or kind of. increasing the amount of bank reserves on depository institutions' balance sheets does not guarantee an increase in the amount of money in the system and the floating around in the real economy, right? Because those banks have to lend out and create money, and that's the money that circulates in the real economy, right? That's what bids up prices and everything else. That's why this past couple years, when we saw the government transfer payments from the pandemic and everything happen, and that money was going towards was given to actual individuals, it went into the real economy, and that's why we see a lot of inflation, right? Or at least we saw more obvious in consumer price inflation. That's an important that's an important distinction to make, is consumer price inflation, right? Because you really have to aggregate, or like kind of separate, like financial economy and then real economy stuff, right? And so you have consumer price inflation, you're buying pizza, chicken, whatever, and then you have financial economy stuff like stocks, bonds, houses, whatever. Yes, giving the banks more bank reserves can do, like, I guess, financial inflation. I don't know how it's like inflation in the financial economy, to where you're seeing the bit up of asset prices, or I guess asset price inflation would be a good way to say it. Because I mean, banks, that's what the banks are buying. They're not going out. You're not going to have Wells Fargo go to Walmart and buy all the chicken. Like, that's not how that works. That's not what they do. They're going to basically give out loans and stuff, create debt, right? So that's the distinguishment to make. And I guess pointing out for the actual currency and stuff for legal tender, I don't know how obvious this would be for you guys. I'll make it brighter or change it to green, maybe even light blue will be easier to see. The actual law, I guess, specifically that does legal tender, if you want to look that up specifically. Right. So going over into non-bank money. So this is where the money is now a liability of a non-bank entity, right? So some financial institution. Money market funds is one example of this. They're not a bank. And so the shares in the money market funds can be viewed as non-bank money. They also don't have money market funds are not depository institutions, I believe, and that's why they're one of the biggest players in reverse repo, is because since they don't have reserve balances, they have to use the reserve repo rate to park money at the Fed. I'm going to stop myself there to prevent myself from going down that kind of rabbit hole. I do have other posts on that and videos, which you can look. If you go on my website, you can see the reverse repo or the repo market posts I've already done, where I do go into that a little bit, into the nuance and stuff, but that's not the purpose of this video. That's there if you want it. I'm stopping myself from losing my train of thought, at least hopefully. We'll see what happens. So to continue, balances held at non-bank financial service providers are typically supported by specific assets or are backed one for one with deposits in a bank account. So other financial service providers, whether it be like brokerages or I guess hedge funds would be put in there. I'm not 100% certain though, but like other financial entities. Over the years, many forms of non-bank money have succumbed to these types of runs, talking about bank runs or equivalent. Indeed, the GFC in 2008 was in large part a crisis of non-bank money, and non-bank money contributed to financial strains against the onset of the pandemic. And so I commented mortgage-backed securities and treasury bills. Again, we talked about how this is kind of another form of money. Again, it's debt. And so the whole idea or concept that 2008 was a function of subprime lending is kind of a half truth. That's not the whole point. That's not why so many are like Lehman Brothers and Bear Stearns, I believe both went belly up for the same reason. And that's why you saw, like, if you look at, I think it was specifically reverse repo rates just went through the roof, or maybe just general repo rates went through the roof at this time. Was because you're looking at the time, the mortgage-backed securities were used as collateral in reverse repo. And so basically when they and then when you're dealing with reverse repo and the amounts, again, I don't know how much I should go in depth with this. There's a one of the biggest factors in the reverse repo or in repo rates is counterparty risk between the institutions, because the data you get from the Federal Reserve, where the Federal Reserve is one of the counterparties, is only part of it. I think it's not even a majority of the repo market. I mean, you're talking about like trillions of dollars every single day in overnight transactions, sort of magnitude. Um, and yeah, so basically they were using mortgage-backed securities as collateral for the repos, and then whenever they found out that these aren't as financially sound as I thought, the interest rates would spike up. So all of a sudden, institutions like Bear Stearns and Lehman Brothers couldn't get overnight funding, and that's why you saw them. I think they quite literally went bankrupt overnight. Maybe not over a single night. I don't remember exactly, but like quickly, to say the least. And I think that's why, is because the problem was in reverse repo, where you're dealing with like transactions of like where a single transaction is like in the hundreds of millions of dollars for a single night, sort of thing. Um, I'll have to look more into that specifically. But now treasury bills are used as pristine collateral. And so you're kind of dealing with government debt instead. Um, so yeah. Anyways, so non-bank money issuers are currently not eligible for certain protections against run risk, including regular access to liquidity from the Federal Reserve and the FDIC for customer balances. Again, because they're not a depository institution, so they don't have reserve accounts at the Fed. And then also FDIC, they don't have federal deposit insurance, because the money they have, like with money market funds, is many magnitudes, or maybe not many magnitudes, but is orders of magnitude larger than the $250,000 limit, to say the least. So yeah, and then typical blank page. I noticed they have, like, if you notice, this PDF says it's 40 pages. It's really not. It's just they have blank pages periodically to separate some of the sections. So it's like, this is page 29. So anyways, here's the last part, the appendix, access to money and payment services. This is the part that I kind of want to leave to you guys to read. So not only do you read the whole thing, because one, I'm kind of a big, I believe in reading through it yourself and not just listening to, even me, listening to whoever, really. Like, you have to remember, it's like, you're listening to another person talk, and so it's different. You need to read it and make your own decisions, right? Do your own research, so to speak, so that you understand it. And then after you read the section and the whole thing, please feel free to start a conversation in the comments, start like an actual discussion about this stuff. The whole point of this entire paper from the very beginning was to they even stated in this, hold on, the whole point of this paper and everything was just to get kind of the idea out and some possible thoughts. And then, like, they took 4.5 months or something like that of just public comments from their stakeholders, whoever these stakeholders happen to be, because they didn't say anything about it. So I don't know. I don't know exactly who these stakeholders are, because I didn't see anywhere where they state that. They just say our key stakeholders, in quotes. But they took public comments on this stuff, and then that period where they take public comments ended May 20th, I think. And then now they're just kind of taking all those comments, commentary, and criticisms or whatever, and basically putting it into another report, and going from there. So, I mean, that's the whole point of this, of the video over the actual publication itself. So feel free to comment and start a discussion. That's the whole point. But anyways, that's all I got for you guys tonight. So hope you guys have a good night. Hope you guys have a good weekend.